Welcome to a new video where we delve into the world of investing and ETFs. Today, we discuss two Vanguard ETFs that dividend investors can buy and hold forever. Now, if you're new to this space, ETFs or exchange-traded funds are investment funds traded on stock exchanges. Much like individual stocks, they're a fantastic way to diversify your portfolio without having to buy each individual stock. And Vanguard? Well, they're one of the world's largest investment companies, renowned for their low-cost, high-quality ETFs, making them a favorite among investors. Dividends, the portion of a company's earnings paid out to shareholders, are a crucial part of any investment strategy, providing a steady stream of income, especially in turbulent market conditions. Today we're focusing on two Vanguard ETFs, specifically designed for dividend investors with a proven track record of consistent returns. Stay tuned as we unravel these two gems from the Vanguard portfolio. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Before we jump into our main topic, let's ensure we all understand what ETFs are. ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product traded on stock exchanges, much like individual stocks. An ETF holds assets such as stocks, bonds, or commodities, and its main aim is to track a specific index. However, it's not just about tracking, it's about efficiency and accessibility. Now you might be wondering, why are these ETFs so popular? Well, the reasons are quite straightforward. First off, ETFs offer exceptional liquidity. This means they can be bought and sold throughout the trading day at market prices. They aren't like mutual funds that only trade at the end of the day. This feature provides investors with the ability to react swiftly to market conditions, which can prove to be a significant advantage. Another crucial advantage is diversification. An ETF can contain hundreds, if not thousands, of stocks or bonds. This means that instead of investing in one company and placing all your eggs in one basket, you're spreading out your investment across a wide variety of companies. This diversification helps to minimize risk and can lead to more consistent returns over time. Cost effectiveness is another compelling aspect of ETFs. Traditional mutual funds often come with high expense ratios and management fees, which can eat into your profits. ETFs, on the other hand, typically have lower costs due to their passive management style. They simply aim to track an index rather than trying to outperform it. This means less research, less buying and selling, and ultimately, lower costs. In addition to these benefits, ETFs also offer a great deal of flexibility. They can be used to gain exposure to virtually any segment of the market, be it a specific industry, a particular country, or a certain asset class. This makes them an excellent tool for both broad market coverage and targeted investments. Also, let's not forget about transparency. ETFs disclose their holdings on a daily basis, so investors always know exactly what assets they own. This level of transparency is rare in the world of investment funds and is another reason why many investors prefer ETFs. Lastly, ETFs are tax efficient. Due to the unique structure of ETFs, investors can often avoid triggering a capital gains tax liability when shares are bought and sold. This feature can be a boon for investors looking to keep more of their hard-earned money. Now that we are clear on what ETFs are, let's get into the specifics. Vanguard is a name that needs no introduction in the investment world. A titan in the industry, it's a moniker synonymous with trust, reliability, and a steadfast commitment to the investor. Vanguard's reputation is nothing short of stellar, and there's a plethora of reasons why it is held in such high regard. Let's start with Vanguard's philosophy. This investment giant operates under the principle of long-term, value-oriented investing. It believes in the power of patience and the potency of compound interest. Vanguard's approach isn't about chasing the latest market fad or making a quick buck. Instead, it's about building wealth steadily over time, brick by brick. It's the tortoise in the age-old fable of the tortoise and the hare, slow, steady, and ultimately victorious. Vanguard is also renowned for its investor-friendly practices. It's structured as a client-owned company, meaning its investors are essentially its owners. This unique structure aligns Vanguard's interests with those of its investors, ensuring that its decisions are made with the investor's best interests at heart. Another feather in Vanguard's cap is its low-cost approach. It has long championed the idea that costs matter in investing. Vanguard's low expense ratios, that's the cost of managing the fund by the way, are legendary in the industry. These low costs translate into more of the investment returns staying in the pockets of investors, which over time can make a significant difference in the growth of one's investment. Lastly, Vanguard's wide array of investment options is another reason why it's a darling of many investors. It offers a diverse selection of funds catering to various investment goals, risk profiles, and time horizons. Whether you're a conservative investor looking for steady income or an aggressive investor seeking high growth, Vanguard has got you covered. Now, let's dive into the two Vanguard ETFs we've all been waiting for. First up is the Vanguard Value ETF, also known as VTV. VTV is a standout player in the ETF universe, and for good reason. It takes a laser-focused approach to investing by targeting value stocks within the market. But what exactly are value stocks? Well, they're shares in companies that are considered undervalued relative to their intrinsic worth. In other words, they're stocks that are trading for less than what they're truly worth, making them a potential bargain for savvy investors. VTV is designed to track the performance of the CRSP US Large Cap Value Index, which represents a wide spectrum of value-oriented stocks in the US market. This gives VTV a broad, diversified exposure to a range of sectors, from financials and healthcare to industrials and consumer services, and it's this diversity that provides a level of risk protection. You see, by spreading investments across different industries, VTV reduces the impact of any one sector performing poorly. Now let's talk about VTV's performance. It has consistently delivered strong results over the years. Since its inception in the early 2000s, VTV has consistently outperformed the market average, proving its durability and resilience amidst various market conditions. And it's not just about growth. VTV has a commendable record of paying steady dividends, making it a popular choice among dividend investors. But why does VTV appeal to dividend investors? It all comes down to the nature of value stocks. Value companies are often more established, mature businesses with steady cash flows. These companies have the capacity to pay out regular dividends to their shareholders. And VTV, with its focus on value stocks, is ideally positioned to take advantage of this. The ETF has a dividend yield that has often exceeded the market average, providing a steady income stream for investors. But it's not just about the dividends. Value investing is all about identifying and buying stocks that are undervalued by the market in the hope that their price will eventually reflect their true worth. This approach requires patience, but it can pay off handsomely. And VTV, with its broad exposure to value stocks, offers an efficient way for investors to implement this strategy. And let's not overlook the cost factor. VTV is known for its low expense ratio, which means more of your investment goes towards your returns rather than being eaten up by fees. This makes VTV not only a potentially profitable investment, but also a cost-effective one. In conclusion, Vanguard's Value ETF, VTV, with its focus on undervalued stocks, consistent performance, strong dividend yield, and low costs, offers an attractive proposition for those seeking steady dividends. It's a testament to the power of value investing and the potential rewards that patience and a long-term perspective can yield. Next, we have the Vanguard High Dividend Yield ETF, or VIM for short. This ETF is a remarkable option for those who are specifically focused on generating regular income from their investments. The VYM is a fund that seeks to track the performance of the FTSE High Dividend Yield Index, which is a benchmark index composed of companies that pay out large dividends. This means that the fund primarily invests in a broad range of companies with a history of paying out high dividends. These companies are often mature, established firms that have a steady cash flow and are less likely to reinvest their earnings back into their business. Instead, they choose to reward their shareholders with high dividend payouts. So, how has the VYM performed? Well, it's proven to be quite resilient. Over the past decade, the fund has provided a steady stream of income for its investors, even during periods of market volatility. The VYM has consistently paid out dividends every quarter, which is certainly a testament to its robustness. Moreover, the VYM is also known for its diversified portfolio. It holds a broad mix of high dividend-paying companies across various sectors, which helps to balance any sector-specific risks. This diversification not only provides a safety net for investors, but also allows them to benefit from the growth of different sectors. But why should dividend investors consider holding VYM for the long term? Well, there are several reasons. First and foremost, the high dividend yields offered by the fund can provide a stable and recurring income stream. This can be particularly beneficial for those nearing retirement or those seeking a consistent income from their investments. Secondly, the VYM's focus on high dividend yielding companies can provide a buffer against market volatility. These companies are typically less sensitive to market fluctuations, which can help protect your investment during downturns. Finally, VYM's low expense ratio is another compelling reason. With an expense ratio of just 0.06%, the VYM is one of the most cost-effective ways to invest in a diversified portfolio of high dividend-yielding stocks. This low cost allows more of your money to stay invested and grow over time. In conclusion, the Vanguard High Dividend Yield ETF, or VYM, is a solid choice for dividend investors seeking a steady income stream and a buffer against market volatility. Its focus on high dividend-yielding companies, consistent performance, and low expense ratio make it a suitable long-term hold for income-focused investors. With VYM, dividend investors have the opportunity to reap substantial benefits over the long haul. So if you're looking for a reliable source of income that can weather market storms, the VYM might just be the fund for you. Now let's compare VTV and VYM. Both Vanguard Value ETF, or VTV, and Vanguard High Dividend Yield ETF, or VYM, are stellar choices for dividend investors, but they offer unique features that can help you diversify your portfolio. Let's start with what they have in common. Both VTV and VYM are exchange-traded funds managed by Vanguard, one of the most reputable fund managers in the world. They both focus on U.S. equities and aim to provide a steady stream of income through dividends. Both ETFs also have low expense ratios, making them affordable choices for long-term investing. However, the similarities end there and the differences begin to surface. The primary difference lies in their investment strategy. VTV tracks the CRSP U.S. Large Cap Value Index, focusing on stocks that are considered undervalued. It's like a treasure hunter, seeking out stocks that the market has overlooked but have great potential. On the other hand, VYM tracks the FTSE High Dividend Yield Index, concentrating on companies that pay high dividends. It's more like a yield harvester, reaping the rewards of companies that generously share their profits with shareholders. Another key difference is their sector allocation. VTV is heavily weighted towards the financial sector, followed by healthcare and technology. This makes sense, as many value stocks are often found in these sectors. VYM, however, leans more towards consumer goods, followed by technology and healthcare. This sector distribution is driven by its focus on high dividend-paying companies, which are often found in these sectors. Now, let's discuss how they fit into an investor's portfolio. VTV, with its focus on value stocks, could be great for investors who believe in the value investing philosophy of buying undervalued stocks and waiting for the market to recognize their true worth. VYM, with its emphasis on high dividends, could be a fantastic choice for income-focused investors who prefer a steady stream of income from their investments. Remember though, while both ETFs can provide a steady income stream, the income can fluctuate based on market conditions. Also, it's essential to consider your risk tolerance, investment goals, and time horizon before investing in any ETF. In conclusion, while VTV and VYM share some similarities, they differ in their investment strategy and sector allocation. These differences make them unique, and depending on your investment goals, one may be a better fit for your portfolio than the other. However, it's not necessarily a choice between one or the other. You could consider having both in your portfolio to take advantage of their unique strengths and further diversify your investments. Both VTV and VYM have their unique strengths and can play a crucial role in a dividend-focused portfolio. We've covered a lot of ground today, from understanding ETFs to diving into two Vanguard ETFs perfect for dividend investors. Let's take a moment to recap what we've learned and why these two funds, VTV and VYM, should be on every dividend investor's radar. Firstly, we dived into the world of ETFs, explaining their functionality and the benefits they offer. They grant access to a diversified portfolio with a single investment, making them a practical solution for those looking to expand their investment horizons without extensive effort. Next, we introduced you to Vanguard, a trusted name in the investment world. Their reputation for low-cost, high-quality funds is well-deserved, and the two ETFs we discussed today, VTV and VYM, are prime examples. Vanguard's Value ETF, or VTV, is a fund that seeks to track the performance of a benchmark index that measures the investment return of large capitalization value stocks. It offers a robust portfolio of companies that are considered undervalued, providing a great opportunity for investors seeking long-term growth and steady dividends. On the other hand, the Vanguard High Dividend Yield ETF, or VYM, is focused on stocks with a higher-than-average dividend yield. This fund is perfect for those looking for a regular income stream from their investments without sacrificing the potential for capital appreciation. Both VTV and VYM offer unique benefits to dividend investors. While VTV provides exposure to undervalued stocks with potential for growth, VYM offers a steady and higher-than-average yield. Both are backed by Vanguard's reputation and commitment to low costs, making them worthy considerations for any investor's portfolio. Remember, investing is a journey, and the key to successful investing is knowledge. We hope that our discussion today has given you valuable insights into these two remarkable ETFs and their potential to enhance your dividend investment strategy. If you found this video informative and helpful, don't forget to subscribe, like, and share this video with your fellow investors. Stay tuned for more insightful content. Happy investing!